In the Bitcoin world, there's a few pieces of advice that are treated as gospel. HODL, stack sats, and never sell your Bitcoin. And if you question it, you're told you're not a real Bitcoiner. That advice works great during accumulation. It's easy to ride out volatility when you don't need the money. But heading into retirement, when you're selling, not buying, that same advice leads people to commit the biggest Bitcoin retirement plan mistake I see, being dangerously overallocated with no risk management plan. I regularly talk with Bitcoiners who are heading into retirement with a 40, 60, even up to 80% allocation to Bitcoin and Bitcoin derivatives like MSTR. Now, on the surface, there's nothing wrong with that high of an allocation. It's when you have that high of an allocation with no risk management plan that you run the risk of watching your net worth get cut in half in a matter of months. And suddenly they go from the guy who was telling everyone that they're set for life to having a very different conversation with their wife and wondering if they'll need to go back to work. But this is easily avoidable with the right approach, an approach that allows you to remain true to your Bitcoin thesis without ruining your retirement plan. I'm Mitch, and this year my firm has already helped 4 Bitcoiners set their 2026 retirement date. And in this video, I'm going to break down our 2-bucket strategy so you can have the best of both worlds in retirement. You can hodl and still manage risk. You can self-custody and still own other assets that are aligned with what's coming. Let's dive into it. Let me start by reiterating the biggest Bitcoin retirement plan mistake that I see. It's an overallocation to Bitcoin and Bitcoin derivatives with zero risk management heading into retirement. Okay, that phrase, zero risk management, is the most important part of this. It's not necessarily that you have a high allocation to Bitcoin and Bitcoin derivatives. It's that you have no risk management plan heading into retirement. How do you end up here? So I want to make sure that if you're watching this and you're thinking about retirement within the next few years, that you don't end up making this same mistake that I've seen from other Bitcoiners. Based on my experience, Bitcoiners end up here due to the FOMO HODL cycle. All right. So you can see Bitcoin's price chart there with some buy words, and then I'm going to talk through some narratives that you're probably feeling or have felt in the past that can get you into this same position and riding this cycle that I see get people into tough situations. Okay, so you can see there back early 2020, late 2019, you may have said, I'll start buying Bitcoin with a 20% allocation, and then I'll DCA continuously over time as I earn more money. So you start buying, you get that initial run up in 2020. Then you make your first FOMO buy there. All right. So a FOMO buy, in my opinion, is you're actually selling other assets, buying more Bitcoin, or you're just putting some additional capital into Bitcoin that may have come in from somewhere else. All right. So you're feeling that FOMO from that Bitcoin run up, and you feel like I need to own more. All right. You might be telling yourself, this is the super cycle. I'm going to be rich. Okay. You're listening to the narratives on X. You're listening to the narratives on Bitcoin podcasts, and you're really getting amped up now. Then China bans Bitcoin mining and we go into a crash. All right. And you're telling yourself now to hodl and stack sats, buy the dips. All right. So you continue to buy all the way through. Then we get that next run up in 2021 and we're making another FOMO buy. This is it. Bitcoin survived that. This is it. All right. So here we go. This is the super cycle. I'll be rich. You make another FOMO buy. Then we head into the Bitcoin bear market of 2022. You didn't see it coming, but now you tell yourself to hodl, stack sats, buy the dip. You continue to DCA and you're buying the dip all the way down through the bear market. At the bottom of the Bitcoin bear market, you may have told yourself this is a generational buying opportunity if you were still confident in Bitcoin. So is this a bad thing? Not necessarily. This is a great time to buy. Okay. But the point is you continue to buy and hodl. So now you're buying, heading into the next cycle, heading into the next bull market of Bitcoin, you're buying all the way up. Now here's the halving, and you're like, all right, my net worth is going to be worth 4x in the next 12 months. You start to run the calculations based on how much Bitcoin I own, the price that it's going to, here's what my net worth is going to be, and Bitcoin has done X, in last cycles after the halving. You're starting to run those calculations. I know you did it. All right. Then you make another FOMO buy. Trump's going to be the next president. We get a big run up in Bitcoin. And you're like, wow, if Bitcoin reaches gold parity this cycle, I'm going to be rich, rich. Okay. I know you ran those numbers too. And then MSTR, it's all over the timeline. All right. It seems like it's going up 10% every single day. Okay. And now there's other Bitcoin treasury companies. Like, this is the institutional cycle, and you make a greed buy, which is just another form of FOMO buying. You're selling other assets. You're buying these Bitcoin derivatives to put on top of your already existing Bitcoin allocation. So now you've got some MSTR, you got some Metaplanet. Okay. And then we get here to the actual top of the cycle. We didn't know it at the time. And you're like, take profits now, even though this is usually where the cycle ends. You're crazy. See you at 300,000. It's all about the business cycle. 4-year cycles are over. Bitcoin winter's not coming back. You're listening to all the Bitcoin narratives. And then you end up telling yourself this: well, 4 more years until retirement. This is a real situation. I've talked with people that have said this. They push their goals back 4 more years because they missed taking profits in another cycle. They missed managing risk another cycle. HODL. So they've gone through this FOMO HODL cycle. Now, why doesn't that work for retirees? That can work for young people that have time, but it doesn't work for retirees. So let's look at Bob's situation here. Bob really wants to retire. He's got a stressful job. It's really starting to impact his health. He wants to spend more time with his family. So now's the time. He needs to do it. He doesn't have another choice. But Bob got stuck in the FOMO HODL cycle. So Bob retires, and shortly after, he goes from being worth $5 million to $2 million. In a matter of months, his 5% withdrawal rate now skyrockets to 12.5%. Safe quickly turns dangerous. Confidence gives way to doubt. Peace evaporates. Stress eats at the back of his mind, even though he doesn't communicate it because he can't publicly admit anything negative about Bitcoin. He tries to remind himself to HODL. He reads expos, listens to podcasts that helped him weather the storm previously. So he feels like that's just what I need to do this time. But this time is different. He traded work stress for financial stress, despite telling himself he would manage his stress better in retirement. He wasn't fully present before, and retirement was supposed to fix that, but it hasn't. His wife wants to take that trip they always talked about, but before retirement, he couldn't possibly take that much time off. But now that his time is free, his wallet is saying no. She doesn't understand. A few months ago, he said that they would be very wealthy and never have to worry about money. So what happened? Bob failed to manage risk at the precise time it was most important. Now, it doesn't have to be that way. Same guy, same bear market, but this time he managed risk before retirement, not after. The bear market hits, he doesn't flinch, his wife doesn't worry, trip doesn't get canceled. That's what the right approach makes possible, and that's what could have helped Bob. And that's what our 2-bucket framework offers. So what is the 2-bucket framework? Okay. The premise of it is essentially viewing Bitcoin from 2 separate lenses within your financial life. And let me be clear, these are 2 separate Bitcoin allocations. So they're still allocated to Bitcoin, but they're 2 separate allocations. One of the allocations you view in bucket number 1, you view it as long-term savings. The other allocation, you view it as a tradable asset. So they're both Bitcoin, but you're viewing them in 2 separate ways. Let me get in deeper on what that means. So first, bucket number 1, what is it and what are the benefits of it? This is how most people view Bitcoin within their financial life. This is how most retirees, really anyone who owns Bitcoin, this is really the only way that they view it, okay? Bucket number 1, long-term savings, it captures the thesis of permissionless scarce digital money. It's optimized for security, held in cold storage. It's optimized for sovereignty. It's optimized for long-term generational wealth. We're never trading it, never touching it. It protects us against black swan events like tyrannical government seizure, like a 6102 attack, for example. It really protects you against those tail risks, and it allows you to have the benefits that only Bitcoin can provide at this point. So that's bucket number 1. We're viewing it as long-term savings, okay? But if we only view it as bucket number one, which is what most people do, it gets them into trouble. Okay. It takes them through the FOMO HODL cycle, leading to no risk or leading to an overallocation with no risk management. I've already described that one. Secondly, most people I talk with don't ever want to use their cold storage Bitcoin to fund a retirement. If this is you and you're thinking about retirement soon, you need to consider this because a lot of people that I talk to, they might be 50, 60% allocated to Bitcoin, but they never want to touch it. They want to keep it in cold storage, untouched, do nothing with it. They want to give it to their kids, their grandkids, which is great. But it's not so great when we need these other assets, the other 50%, to provide for our retirement. And if those assets can't, we have a decision to make. All right. And that's where the 2-bucket framework takes care of this. It solves that problem. All right. You don't have to just view it as bucket number one, Bitcoin. Last bullet point, it leads you to avoid including non-cold storage Bitcoin alongside traditional assets in a portfolio. So most people, when they only have a bucket number one mindset, they view Bitcoin completely separately from their traditional asset portfolio. And they fail to see how Bitcoin could actually benefit that portfolio if it's managed properly, if it's viewed as a tradable asset, not a permanent allocation. Okay. And so most people, they don't blend these two worlds. They keep their Bitcoin completely separate and they think about it separately. Then they have their traditional asset portfolio and they think about that completely separately. What our bucket number two does is it allows Bitcoin to benefit our traditional asset side as well. And I'll get into that more here in just a moment. One piece of encouragement. If you're nearing retirement, or maybe you're just in retirement, you're in retirement right now, don't let yourself be chained to old thought patterns. This new season of life requires a new mindset, and it requires a new approach. These are two distinct phases of life: accumulation, retirement, accumulation, retirement. Two different approaches are required. Two different mindsets are required. You need an approach that intentionally and intelligently manages risk to safeguard your family's future no matter what happens without sacrificing upside. Do not miss that. All right. Whenever I talk about this, most people think that, oh, well, I'm going to have to sell some of my Bitcoin and I'm sacrificing long-term upside. That's the benefit of bucket number two. Even if you're selling right now, you will be buying back if Bitcoin takes off again. I'll get into that. Okay. All right. Before we go on to bucket number two, though, what is the right bucket number one allocation? You might have already asked yourself this. All you need to do is answer one question. If Bitcoin went to zero, would my life be okay? That's the only question you need to answer. So you need to run projections based on the goals you want, based on your retirement spending, taxes, Social Security, all the retirement factors. You need to run the projections and you need to assume Bitcoin goes to zero. And then look at, okay, what is this? What are these other assets? What type of retirement will they be able to provide? And if you're okay with that, then you have arrived at your right allocation for bucket number one. If you're not okay with that, then you might need to decrease your bucket number one allocation. And you decrease it until you say, I'm okay with what this would provide me if Bitcoin went to zero. Okay. Now I want to address a common misconception, because this is, why is this the only question I need to answer? Well, if Bitcoin plays out to the upside, it doesn't make your other assets worthless. Most people they believe that. It's a myth, okay? That's not going to happen. If you own equities, for example, companies that produce products, companies that deliver services that are valuable to people will continue to be valuable on a Bitcoin standard. Now, commodities, they go into actually making real stuff. They're still going to be valuable on a Bitcoin standard. Fiat debt, on the other hand, probably not going to be valuable. Okay. So just be honest about that. If it plays out to the upside, these assets are still going to be worth something. And the beauty of the 2-bucket approach is if it plays out to the upside, bucket number two is going to take advantage as well. You're not just getting Bitcoin exposure through your long-term savings, you're also getting it through bucket number two, the tradable asset allocation within your portfolio. That's the key. Now, I know that answering this question is not necessarily a precise mathematical answer, but it gives you the foundational context for decision making. I know it's extreme, but again, we have to set the foundation to be able to make these decisions. We can't just kind of pull it out of thin air. We can't make these allocation decisions unintentionally with no real data or framework to do so. Last thing here, when most people make a Bitcoin allocation, they feel like it's a permanent decision. They can't unwind it. They can't change it. But your retirement plan and portfolio can and should adapt over time. Feeling like an allocation decision is permanent or can only increase over time is what gets retiring Bitcoiners into trouble. That's what the smartest people do. When they're presented with new information or circumstances change, whether it's in your situation or in Bitcoin or maybe in the world, whatever it might be, when that information changes, their plan changes. They adapt accordingly. That's what the most successful people do in retirement. Now, bucket number two, what is it and what are the benefits? Well, first, not only is it an option to trade Bitcoin, it's a smart option, in my opinion. Not your cold storage Bitcoin. Let me be clear. Bucket number one remains untouched, never traded. It's just your bucket number two allocation. Okay? But it's good to still include Bitcoin in a traditional portfolio because Bitcoin has had great returns. And it has a very cyclical nature at this point that can be taken advantage of with an intelligent trading strategy. All right. But when we offer this option to Bitcoiners, they feel like a tension and a pressure lift. They feel a sigh of relief. Okay. Most Bitcoiners, and you might experience this yourself, they feel this tension of, I feel like I need to take some off the table, but I feel like a fraud for selling. Okay. So whenever we give them permission to do this, they take a deep breath. They feel peace. They feel confidence. They feel a little bit more clarity about how to approach this the right way. All right. Bucket number two views Bitcoin as a tradable asset. It can be spot Bitcoin or Bitcoin ETF alongside your traditional assets within an IRA, Roth, or brokerage account. Now, honestly, I'm perfectly fine, and we utilize an ETF for our clients within bucket number two because it makes it easier to manage a holistic portfolio if I can sell the Bitcoin allocation and allocate to something else right there on the same account, same custodian. I don't have to move the assets from another custodian to a traditional custodian in order to buy the other assets. So that's what bucket number two is. Then lastly there, it allows you to participate in the upside of Bitcoin without being fully exposed to the downside or longer than expected chop. This is the benefit of bucket number two. This is why you can feel comfortable decreasing your bucket number one allocation. Because if you decrease your bucket number one allocation, but then you also have your bucket number two allocation, it might be able to allow you to have the same or higher even Bitcoin allocation when it makes sense to, when Bitcoin's actually growing, going up in price. All right. It allows you to avoid being fully exposed to volatility or the chop, which is a wonderful benefit for people in retirement with a large allocation to Bitcoin. All right. Here's how to make the most of bucket number two. I'm going to tell you exactly how. First, you must unemotionally and systematically trade based on technical market indicators to capture trends. Okay. What do I mean by unemotionally and systematically? It means ignoring fundamentals and narratives on X and Bitcoin podcasts. All right. You can't listen to what Trump said. You can't listen to what Saylor's saying. You can't listen to what Jack Mallers talked about on his podcast. You're not listening to what El Salvador is doing. Who cares how much Bitcoin MSTR bought? I don't care about the success of STRC. I don't care about any of that. All I care about is what is the market price of Bitcoin doing and what are my technical indicators telling me to do? That's it. That's how you successfully execute a bucket number two approach to Bitcoin. If you do it any other way, what you're now doing is you're inviting in no risk management again. All right. Because you're just going to follow the Bitcoin podcast, the Bitcoin X influencers. You're going to listen to all the predictions, all the analysis, all the prices they're throwing out, what's going to happen. This time is different, all that kind of stuff. And you're going to make an uninformed, emotional decision, a non-systematic decision. Can't do that. It's very important. Next, now that you have that set in stone, you have to establish a clear system for what you'll reallocate the capital into when you sell Bitcoin. So when you finally get a sell signal on Bitcoin, what are you going to do with the capital? You have to establish that ahead of time. That's very important, okay? Because if you don't, what's going to end up happening? One of two things. You'll hold in cash for a lot longer than you want to, or the second thing is you're going to buy another asset that you're feeling FOMO for, whether it's gold, silver, whatever, oil, whatever it might be. Okay. So you have to make sure that you have a system that predetermines what you're going to do with that capital so you can continue to be unemotional and systematic. You cannot introduce your emotions again once you sell the Bitcoin. And ideally, you want to make sure what you're reallocating into is still aligned with the fourth turning thesis, and it's uncorrelated to Bitcoin. So it doesn't move the same as Bitcoin moves. If you have that, you've found exactly what you need. Lastly here, it can be a 10 to 33% allocation within bucket number 2, not a global one. I've already told you how to arrive at your bucket number 1 allocation. Bucket number 2, I believe, 10 to 33%. It doesn't need to be any more. This, I believe, and I've seen it happen, this will give you peace of mind, clarity, and confidence. Plus, it'll help your spouse feel better about the strength of your retirement plan. Okay? So most of the people that I talk with, they have one of the spouses is a Bitcoiner, the other is not. And the non-Bitcoiner spouse loves the Bitcoiner, doesn't care very much about the Bitcoin. All right? And so they feel a little uneasy heading into retirement with a high allocation. And so introducing this 2-bucket framework and approach, it actually helps both spouses find a win-win. The Bitcoiner feels like they're going to be properly taking advantage of the upside, while the non-Bitcoiner feels like they're properly managing risk. So you get the best of both worlds, both spouses on board, confident in the retirement plan. This has been a huge unlock for our clients. This is honestly maybe more valuable than just the dollar amount, of what we're able to make our clients or save them with this approach. Very important. Now let's visualize this in action. If you're a visual learner, this will help you to see it play out. Okay. So in this situation, this person has a long-term savings bucket allocation of 25%, and they have a tradable asset bucket, number 2, allocation of 33%. So their global allocation to Bitcoin is 58%. So in total, they have a 58% allocation during Bitcoin bull markets. Okay. Let me be clear. When they have buy or hold signals on Bitcoin, they have a 58% allocation. So they're taking advantage of the Bitcoin bull market with 58% of their net worth. Pretty good. Most Bitcoiners are going to be very happy with that. They'll feel good. They're not going to feel that FOMO of missing out. However, when we get the systematic sell signals on Bitcoin, we sell the bucket number 2 Bitcoin. Again, not selling bucket number 1. So we're selling bucket number 2, and this is what it looks like now. Heading into a Bitcoin bear market, now we're writing out the bear market with a 25% Bitcoin allocation instead of a 58% Bitcoin allocation. Much different results. All right. So we're selling bucket number 2, holding bucket number 1 always, and that gives us a 25% allocation during the bear market. All right. Now let's visualize this with some numbers. So using the HODL only approach, in that situation, a $5 million person a person with a $5 million net worth that has a 58% allocation, they're HODLing only. If Bitcoin is a 70% drop, they lose $2.03 million approximately. If you use the 2-bucket approach, and you sold your bucket number 2 allocation, but you held your bucket number 1, so you're going through the bear market now 70% drawdown with only a 25% allocation, not a 58, you only lose $875,000 off of your net worth. Very different experiences. It's a $1.2 million higher net worth with a 2 bucket approach. Now, when does this really get good? It gets good when you sell your Bitcoin and you reallocate to assets that are increasing in value while Bitcoin is decreasing in value. Okay. So if you believe that I'm crazy and this is not possible, well, we've actually done it. We did it with our Fluvius portfolio for our retired clients over the last 3 months. So we did it with real portfolio, real clients, real results. Your net worth could actually increase with the 2 bucket framework during a time when the HODL approach would lead to a 25 to 40% decrease. So imagine Bitcoin's going into a bear market, it's falling off a cliff, everyone's freaking out, and your net worth is actually increasing during that time. How incredible would that be? So why do we believe this is the best approach, the 2 bucket framework? Well, it checks all the boxes. It gives our clients retirement income, which is a very important one because in this situation, you only take your retirement income from bucket number 2. You're not touching bucket number 1, which is what the goal of most Bitcoiners is. They don't want to touch their cold storage Bitcoin. So we take all the retirement income from bucket number 2, which still takes advantage of the Bitcoin upside. Very clear. So that's a big one. Next, we're generating returns while Bitcoin isn't performing. We've seen this play out with our clients. 2025, Bitcoin was flat, 2026, down. So we've seen this play out. We've been able to generate significant performance while Bitcoin isn't. Now we're managing risk intelligently. We have security in 2 ways. We still have security with our cold storage Bitcoin, and we have security in our retirement plan. We feel secure that this will work. We still have sovereignty because we're still holding our cold storage Bitcoin. So if things hit the fan, we have a black swan event, we still have that. And we're probably going to be good with the amount that we have in there. Next, we're maintaining alignment with the Bitcoin thesis. Very critical for Bitcoiners. Lastly, arguably most valuable, you have peace, confidence, and clarity. So it checks all of these boxes using the 2 bucket framework. Let's go back to the same story I shared at the beginning with Bob in his retirement. Now, let's say he uses the 2 bucket framework instead. So same guy, Bob, same $5 million net worth, same desire to retire, be present with his family, leave stress behind. But this time he didn't let HODL and narratives dictate his entire financial plan. He separated his Bitcoin into 2 buckets. His cold storage sat untouched, sovereign, secure, and right-sized to an allocation he could live with no matter what happened. The rest of his net worth was managed across an active, diversified, but still positioned for growth portfolio that included a Bitcoin position within bucket number 2. When the bear market hit, bucket number 2 had already exited its Bitcoin position based on a systematic signal. His net worth didn't fall from 5 million to 2 million. It pulled back to 4 million. Very different experience. His withdrawal rate didn't skyrocket to 12.5%. It only moved up slightly to 6.25. Not dangerous, not life-altering. He didn't doom scroll X looking for reassurance. He looked at his plan, saw that it was working the way it was designed to, and he went on with his day. His wife brought up the trip again. This time he didn't hesitate. He said yes, because he could afford to, because the plan accounted for this. She felt secure. He felt confident. And the stress he left behind at his job didn't follow him into retirement because he made the right decisions before he walked out the door. That could be you. If you want to know how we manage bucket number 2 for clients, you can watch this video right now. It's our proprietary investment strategy, Fluvius, and this is exactly the portfolio strategy we use within bucket number 2 for our clients. We currently manage over $32 million within this strategy, and in that video, I break it down step by step how it works. So you can go watch that now. Again, I'm Mitch. My firm is Strong Wealth, a wealth management firm for Bitcoiners, helping them retire early and stay retired without sacrificing their peace. Thank you for watching.